Kate, what do you think about my new Allbirds?
Oh yeah, your new Allbirds among all the other new shoes in this season's collection, so to say. I like the Allbirds. They look nice, and I have a pair myself, let's say maybe even a couple, because they're so comfy. But did you buy them because they're a very clean company, they use wool, they don't kill sheep, and so they have these social values that they put them front and center. Did you buy your Allbirds because of their social values?
I actually don't think I did. I bought them because, as you say, they're some of the comfiest shoes around. I think that the socially responsible side helped. You feel a little bit better about the purchase because you bought something that's good for the environment. But ultimately, I don't think it drove my buying decision. And maybe not everybody knows what Allbirds are. They're a shoe company. They're from New Zealand. And their big shtick is that they use wool, which supposedly is a lot more sustainable than leather. And I guess that's what you were referring to. Funny thing is, my sister claims she will never get caught in a pair of Allbirds.
So those Italians, they only wear high heel shoes. So, gotta cut her some slack. She just hasn't ever owned a pair of Allbirds.
Yeah,
And if she does, you never know what she's gonna do.
You're right. I actually, funny you should say, my mother also swore never to wear them. And not, after she tried them, now she loves them.
That's one thing that we seem to want to talk about, buying this product, buying the shoe. But let's look at another question here. Would you buy a stock in Allbirds? Allbirds became a publicly traded company not that long ago. Would you invest in them?
Well, so I think I wouldn't, Kate. And
ouch.
Well, okay, so Allbirds has some specific problems, to be honest, as a company, right? They went public recently, and they actually, I think they've been mismanaging the product line. But I think that what you're hinting at here is more, would I invest in a company because it is socially responsible, right? Is this where we're going?
That is correct. That's correct. Yes. And Allbirds is just one example of such a company. There's Patagonia, and there's a whole set of firms that really bring up their social values front and center for investors to consider. So I guess the big question is, do these companies that promote their social values, are they profitable investments?
I think that's a question that we're going to explore today, right? But we do have a lot of voices telling us that woke firms go broke. And so I guess we have two questions today, whether you want to word it in a more politically correct way or manner. It's either, do woke firms go broke, or do socially responsible firms underperform? Welcome to Questions in Finance,
a podcast where we translate academic mumbo-jumbo to answer interesting questions in finance. I'm Kate Holland.
And I'm Veljko Fotak. Kate and I met when we were PhD students at the University of Oklahoma.
Today, we're university professors, and we spend our days teaching and researching companies, markets, and all things related. So let's unpack this question. Do woke firms go broke? In other words, do socially responsible firms underperform?
Well, let's dissect this for a second. Why do we talk about underperformance specifically? On one side, we are classically trained economists that grew up in a post-Milton Friedman world. Friedman, of course, being the Chicago-based economist that in the 1970s, in 1970, enshrined a new worldview by stating that the social role of corporations, or the only concern of firms, should be the maximization of shareholder wealth, which became effectively our business school mantra.
For sure.
We have been taught that firms maximize shareholder value by focusing specifically and uniquely on shareholder value. And mathematically, it is an argument that makes a lot of sense. You achieved the most optimal outcome in terms of wealth with unconstrained optimization. That is, if you start prioritizing or co-prioritizing other things, society, the environment, and so forth, you will stray away from pure wealth maximization and your wallet will suffer. that's how we have been trained. And yet, we do see novel evidence on the other side of this debate at the micro level, at the firm level, that finds that there are possible, real, and tangible rewards for socially responsible behavior that translate into economic performance as well. So, for example, your customers might be more likely to buy your products or pay slightly higher prices. You might get into trouble a little bit less often with the Environmental Protection Agency, or perhaps sued a little bit less often in worker compensation claims if you're a socially responsible firm that doesn't pollute or treats workers fairly. And interestingly, some of the strongest effects that we are actually going to see in the academic literature are coming from the financing side.
Yep, correct.
Banks give socially responsible firms cheaper loans. It's like a halo effect. There is this assumption that because you're polluting a bit less or treating your employees a little bit more fairly, you're less likely to run away with my money. And well, there is research that actually seems to suggest that there is some truth to that. And finally, we do have right now a political backlash against socially responsible investing, with voices mostly from the right of the political spectrum telling us that woke firms go broke and justifying opposition to socially responsible investing on the basis of alleged underperformance. So this is a bit of context of today's question and where we are coming from. Well, there's lots and lots to unpack here. Probably a good way to start this conversation is to figure out a couple of definitions, right?
For sure. I have to say, I totally dislike this woke slang. It just makes my skin bubble, so to say.
Okay, I think that's a fair point. Woke, it feels like it's been hijacked a bit as a term, right? I mean, it should have a positive connotation. You're awake, you're aware, right? You understand what's going on around you.
Definitely doesn't have a positive connotation in today's world.
I think it has been hijacked by the critics of social activism, right? In implying something negative about it. The good news is that in finance, that's not what we generally use as a term. We usually talk about socially responsible firms, and we actually tend to slice it a little bit more. When we talk about socially responsible firms, people in finance will often fall into the use of an alphabet soup. We like talking about ESG, right? So firms concerned for the environment, for society, and for governance.
Yep, that's right. E for environment, S for social, and G for governance, right? This ESG matrix. It's another way to refer to it, also CSR, so to say, corporate social responsibility.
Well, I mean, the alphabet soups are endless. There's CSR for corporate social responsibility. There's SRI for socially responsible investment.
That's right.
There's ESG, of course. As we said, and I'm sure we could keep at it. But okay, what we're talking about here is how concerned are firms for the external parties, for society, how concerned are they about their impact on the environment, right?
Correct.
On the other side, I think that we need to spend a moment talking about performance.
Right. We want to see whether the socially responsible firms have better performance than socially irresponsible firms that are similar, like in the same industry, right? Or what?
Yeah, but I think that in some ways today we're going to keep it narrow, right? When we're talking about performance in this episode, we're going to be talking, do socially responsible firms generate profits?
Right. And because you could talk about performance from so many different angles. I mean, you can talk about are they doing good for their society? Are they doing good for their employees? There's so many aspects, but today you're correct. We're going to focus on one specific aspect. If the firm is profitable, meaning do they provide higher stock returns over time if they're socially responsible?
When you say something interesting, I guess we would all somehow imply or almost give for granted that a socially responsible firm leads to better social outcomes, right? Yet, it's far from granted that the firms that we rate as being socially responsible actually achieve socially desirable outcomes. We are going to be looking at firm profitability in a narrow sense. Do they generate returns for investors and shareholders, right? At the end of the day.
Stock returns.
Right? Correct. And leave out the social question.
So we will be talking about profitability from a point of view of corporate profitability, corporate earnings, and also a measure of stock returns, which is related. So for earnings, when we're talking about earnings, it's literally how many dollars a company makes from their sales minus expenses, the earnings on net income, related measures that listeners could have heard, things like EPS, earnings per share, or ROA, return on assets, or ROE, return on equity. All of those performance measures are related to profitability, are driven by corporate earnings. So we will be talking about profitability from a point of view of corporate profitability, corporate earnings, and also a measure of stock returns, which is related.
Then there was another point that we probably need to make, which is the necessity to talk about risk-adjusted
Return.
returns.
So the basic concept there is the higher risk something is, the higher returns that something should provide. So if your investment is riskier, it should provide you with a higher return to compensate you for that risk. The
Absolutely.
lower the risk, the lower the return. So let's talk about, if we think about ESG firms that have high environmental, social, and governance standards versus low,
Correct.
which ones are riskier?
How we generally interpret low levels of social responsibility in finances as a risk factor in many ways. If you're looking at the environmental literature, that's when these things become the most obvious. Firms that don't behave well in an environmental sense tend to get sued. Think about oil spills in the Gulf and things like that. So in some sense, I guess if we are comparing the performance of socially responsible and socially irresponsible firms, the danger here is that the socially not responsible firms are riskier. They produce a higher return, which is compensation for risk, and perhaps not even sufficient compensation for risk. That does not mean that they're creating higher value in a risk-adjusted
So we are comparing like apples and oranges when you're looking at something that's safer and something that's riskier. So you need to make all of them plums, right? So you need to look at the risk-adjusted returns, basically.
Correct. So, hopefully all the studies that we are going to be mentioning today are going to try to adjust for the risk, but we know that research is not always perfect, and we'll try to comment on some of that.
Yeah, so again, in terms of how we're measuring performance here, we will be looking at corporate performance and specifically earnings and some stock return, especially risk-adjusted measures.
Awesome.
Right. I think it's going to be too cloudy if we don't quickly explain before we get to the end of the episode to our listeners what we mean. Like a quick example here, like you can think of what we call brown firms, these like oil firms that are basically drill for oils. They're polluting the environment in a way, right? But they actually produce the largest amount of green patents. You can see that many of the oil firms are going to be ranked as very green, and they will rank very high on ESG. So here we have a firm that ranks very high on ESG, but is it really that good for society? That's the questions that we are highlighting here. But actually, just wanted to clarify that.
Yeah, but maybe I think this is why nobody trusts us researchers anymore, right? Because we have oil companies rating high on the E dimension.
In their defense, I mean, we need to drill for oil, and if some of them make some green patents that make these technologies less polluting, that's a big plus.
Okay, we'll get to the E in a second, but I think that in some sense...
You want to start backwards. You want to go ESG. You want to start with G. So you want to start with the last letter?
Yes, I do. Perhaps because I think it's the easiest one. I mean, let's get it out of the way, right? What we want to do now is take a little bit of a deep dive into some of the empirical evidence. And the good news is that research in finance is actually documented how the G impacts performance.
We are talking about governance here. And what is governance? Governance is a set of mechanisms that allows the firm owners, who are everyday investors, you guys who are listening to this podcast, to have an interest alignment with firm management, like the CEO of the firm, the executives of the firm, so that they're all looking forward towards making the firm profitable. So these governance systems help align these interests.
And not to nitpick, but hopefully we're aligning the managers with the interests of investors, right? And not the other way around.
Correct. Of course.
Yeah, I knew what you meant, but you just made for an easy target. No, so jokes aside, governance, institutions, and rules and regulations that align the interests of managers and investors. You're absolutely right. Now, I've often felt a little bit awkward here in including governance within the ESG domain or the debate on socially responsible firms. I know you feel slightly differently about this, Kate, but my view has always been a well-governed firm can choose to do socially responsible things, or a well-governed firm can choose to do socially irresponsible things. And I'm not sure that the G really aligns with my understanding of corporate social responsibility.
Yeah, so just to translate it, I think, let me see if I'm understanding what you're saying. What you're saying is that firms that have very efficient governance mechanisms, these firms that are efficient in terms of how they run, in terms of alignment of interest between shareholders and managers, could actually still produce products that are bad for society in a way, or produce products that are good for society. They can do it very efficiently either way.
Yeah, I mean, you can be very efficient at being an evil bastard, right? I mean,
Well, that's where my not objection, but I have a different point of view. I feel like if the firm is well governed, those will be good firms overall, and that's where the connection between the governance and S stands from this like overall goodness. But again, yeah, we will get to that later. But I agree with you. I think that governance is the cleanest out of the dimensions of ESG, and I'm not sure how it was actually tagged on to ESG because there's not much directly related to social responsibility in there. I mean, we're talking about independent directors, CEO chairman roles, salary.
let's give our listeners a couple of examples of what we mean with good governance, right? You mentioned having independent directors, that is, having directors on the board that are truly monitoring CEOs and keeping management honest.
Yeah,
right?
yeah, not like your uncle, who's sitting there and you are the mafia boss or something like that.
Is this because I'm Italian?
Oh, no, just an example that came to
So
mind.
this wasn't personally you. So we were talking about governance, and you said why is it included? I have a cynical view, right? I think that when portfolio managers had to justify the use of these ESG criteria in investment, they wanted to justify it on the basis of performance. ESG portfolios perform well, and of
That's
course,
the stories they wanted
were
to
talking
sell.
about
That's the stories they wanted to sell, basically.
absolutely, but
Because they wanted to get money from investors,
But-
and
but-
that
but-
sounds like a good story.
But to me, it feels like the G was tackled in there not because it philosophically belongs, but because it actually does seem to generate positive returns.
So you're suggesting that there's solid empirical evidence that good governance is related to positive returns. Let's name a couple of papers, like some key ones.
I'm going to stick to the big one, right? And I'm going to talk about Gompers, Paul Gompers, Joe Ishii, and Andrew Metrick, and their paper published in the Quarterly Journal of Economics in 2003. And for people that do work in this industry, they created something known as the governance index, or the G.
GIM index, the GIM.
So this G index, they take 24 variables measuring different things about the governance of the firm. Effectively, what they're trying to measure is how strong is the power of the manager, right? So they identify firms that they call dictatorial, where management is really strong. And on the other extreme, they have more democratic firms where presumably manager operates in the best interest of shareholders.
Right.
And here is the big clincher. They're going to create portfolios of democratic firms, the
Right.
good governed firms, and what they call autarkic firms or dictatorial firms, the poorly governed. They're going to look at the difference in returns,
Right.
and they're going to show us that, I guess this was the mid-'80s, there was a 9%.
The punchline's coming. So yeah,
The punchline is a big number. The abnormal return on the well-governed portfolio is 9 percentage points a year.
Wow. So if my portfolio consists mostly of firms with better governance, I'm gonna make 9 percentage points more a year versus a portfolio of similar firms, but that are not as well governed.
I just don't contextualize that 9%, right? Equity returns
Yeah.
at the time were about 9% a year, right?
Wow.
So
yeah.
what this means is that you're doubling the
Right.
return on your equity portfolio if you're restricting it to well-governed firms. Now,
Impressive.
it
You
did.
definitely want to have your money in well-governed
Well,
firms.
but I mean, it's not really surprising. I mean, well-run firms perform well. I mean, now to recognize what GOM precision metric deserve, they found a way to measure it, right? And they found a way to rank firms. Kudos to them for their work. Now, as we said, their work actually is built on a lot of prior research that shows that these individual things matter, right? And there was a lot of research coming afterwards. And I'm not gonna, we should probably pretend that all of this is totally uncontroversial, right? I believe that it's fairly uncontroversial that well-governed firms perform better. How exactly you measure them, how exactly you
Right, there's
identify
so
them.
many quirks in there. That's right. But I think we've said enough for now.
That's correct.
Yeah, that's definitely a very strong result. G is positively related with returns. We've covered G of ESG, one of the dimensions, and there exists a clear relationship there. Firms that have higher Gs, that are better governed, have higher returns. But we're not quite so sure that G belongs into this group of socially responsible actions of firms.
Yeah.
That's one of the views is marketing. So let's move on. Let's move on to our next factors. Let's talk about this E factor and then the S factor. So what do you have to say about this E factor? Is there a relationship between firms that are environmentally stronger and their returns? Firms that have better environmental policies, do they over time provide better returns to their shareholders?
Kate, we were talking about definitions, and the E stands for environment.
Environment, right? I mean, look, so what we mean there by E, there's multiple things, but we're obviously going to be talking about E emissions and emissions.
Broad metrics of impact on the environment, right?
That's correct. Yes.
I read an article in The Economist recently that was arguing that we should just look at emissions only for the E. Their point was that it's the most objectively measurable dimension.
These emissions, there's a lot of super cool data sets. One is known as true cost. So this true cost data set provides emissions and splits them into scope 1, scope 2, and scope 3 emissions, depending on the severity of the pollutants that the company emits.
That does sound pretty intriguing. It's the most objectively measurable dimension, but clearly it's an incomplete one, right? Water pollution, there's also some other things that there's how much trash you're producing, right? There are all these other effects. But okay, to just wrap our head around, the E measures how the firm contributes positively or negative to the natural environment around.
Correct. We're going to be talking about climate change related issues here, brown and green firms. So all of this kind of sits under the E umbrella. So, and those were just some examples of what gets counted under this E dimension.
Absolutely. Awesome. And here, Kate, I did a deep dive into the literature on the E, and the problem is it feels like drinking from a fire hydrant, right? There's just so much. It's the hot topic of the day. Everybody's writing about. So let me start with what I think is a great literature review paper. This is work by Gurman Friede, Timo Bosch, and Alexander Bassen. This was published in 2015 in the Journal of Sustainable Finance and Investment. And I wish they could see you. So Kate is a journal snob. Let me explain this. We clearly have better or let's say more selective journals in our profession, and some which are perhaps not quite as selective. And this journal, it certainly doesn't rank towards the top. And Kate and I perhaps differ at times in how much weight to give to.
I'm interested in listening to the findings.
Well,
any literature is
so-
going to be interesting because they review the literature. It's not that I'm a journal snob. It's probably shows my ignorance because I'm not too familiar with the journals outside of the top 6, I would say, in finance, accounting, and economics. So
that's the definition of a journal snob. But okay, so let me blow your mind here on what these researchers did. So Friede, Bush, Bassan, they actually reviewed 2,200 individual studies
no
published
way. Can
over
you
the span
imagine?
of 40 years.
2,200 studies. These are
You-
papers on ESG.
Correct. All of them, not only papers on ESG, but papers specifically on ESG and firm performance. Actually, some of them are about firm performance, some about ESG and the performance of investment funds. So they look both at the corporate side and at the investment side of the debate, if you will. But okay, let me give you one figure here that I think really summarizes a lot of it. Out of the studies that look specifically at corporate performance, 59% document a positive association between environmental performance of firms, environmental ratings of firms, and their either stock price performance in some of these studies or operating performance metrics.
Okay, so 59 sounds pretty good. So then the question is, what was happening to the other 40% there, right?
Okay, so 59% are finding a positive association. 4% of studies actually find the opposite. They're actually finding a negative association. And
Interesting. But
yeah, so roughly speaking, you have this almost 60% of studies finding positive, 4% finding negative, and then the remainder 35% or so finding no association. What does one draw from this? If you go back to our original question, do woke firms underperform? Do socially responsible firms
and if we consider
underperform?
E as the definition of woke here, being environmentally safe, environmentally positive, so
Well, I
to
mean,
say, as woke in
I
that
guess
perspective.
on the G dimension, we already ruled out underperformance.
Right.
It's quite the opposite. Well-governed firms outperform. Now we're on the E, and the evidence for underperformance comes from 4% of studies, 60% finds positive. I think that if you're asking me, do environmentally conscious firms underperform, then the answer is a resounding no.
No.
If you were asking the opposite side of the question, do environmentally conscious firms outperform? I think I would be a little bit more cautious. 60% of studies find that yes, they do, but then 30% of studies find they don't. Right? But there is another point that we probably should raise in this conversation. Correlation is not causation.
Right.
And in general, that's been a problem in this stream of the literature.
Yeah, so when a firm, you're saying it gets wealthy and profitable, that's when it's going to start caring about the environmental factors and will start improving its performance and so on. For example, I know that the University of Missouri had one of the cleanest power plants here, and they worked hard to achieve that status, after which Berkeley took the first spot as having the cleanest on-campus power plant. But neither of the universities could have been thinking about having the cleanest power plant if they weren't making enough money from tuition and if they weren't profitable.
Oh, no, that's a really interesting point. I'm actually discussing a paper at a conference next week, and one of the authors is Houston,
Texas.
No, Houston being the last name of one of the authors. And the funny thing is,
Houston, Joe Houston.
Oh, is that what it? Oh, okay. See, I'm totally unprepared. Yes, but that's absolutely correct. The title of the paper, which I'm also unprepared, 130 years of corporate social responsibility, I believe is the title of the paper.
Wow,
right?
nice. So
actually, I was just reading it this afternoon and not preparing for this podcast, but preparing for the conference. And they do something that's really cool. They actually use language processing and they scan news articles back 100 and so many years, right? And again, I'm fuzzy on the details, right? I just read this first draft. But so they go back 100 plus years and they scan news articles and they actually find when concern for the environment is the highest in the population. And then they link it to macroeconomic factors, wars, events out there. And the big finding is that when the economy is doing really well, there's a very high level of concern for the environment. When the economy does poorly, nobody cares, right?
Right. So this is interesting because this is going back really historically back 130 years. Because if I were to date this ESG interest for the public, I'd go back probably to like sometime around 2010, 2012, when people started talking about socially responsible firm, and even more, I would say maybe 2017 and 18, whenever we've seen more votes in shareholder meetings that are favoring corporate disclosure on environmental factors. So I would say that this interest in ESG for investors, it's only been the last decade or so. But interesting that they find that if you go back over the last 130 years, this interest exists, but it exists when we are in good times.
Right. So we are back from our break and we are now in our office. For full disclosure, we were previously on Kate's boat.
And it might have been a bit windy. So if you hear some wind noises, that's what it's coming from in the first part.
We'll see if we can clean it up in our post-processing. I have a creaky chair here. So we'll see whether the chair is better than the wind. Okay. So we were talking.
No comment.
Well, we do have our notes in front of us, so let's recognize the authors here of 130 Years of Corporate Responsibility.
Joel Houston,
Sihon Kim, and Boyan Lee. They certainly deserve recognition for this great paper. So back to us. We were talking about E and performance, right? Do firms that rate high on environmental performance actually produce abnormal profits? As I said earlier, it's almost like drinking from a fire hydrant, but I'll mention a couple of papers. We have a paper from the Financial Analyst Journal published in 2004, portfolios of firms with a high E. They find 6% per year abnormal performance. Another paper, Journal of Banking and Finance, a couple of years later, it was published in 2014. It's a paper by Pak Chan and Terry Walter, and they actually find something very similar. They make portfolios of firms that rate high on environmental performance, and they get an abnormal return of around 7% per year. So quite strong results. They actually dig a little bit into the corporate side as well. They find that firms that rate high actually have an easier time getting loans, an easier time raising capital, and other positive spillovers as well.
I'm going to add to that. There's a paper by Bolton and Kasperchuk. That's a 2021 Journal of Financial Economics. That's Patrick Bolton and Marcin Kasperchuk. And what they show is a link between carbon emissions and firm returns. So firms that have higher total carbon dioxide emissions, so, produce more polluting substances like carbon dioxide, earn higher returns. So they're compensating their shareholders for this additional risk.
Oh, yes, Kate. And that's a great paper, and of course, published in a great journal. And yet, I do think that there is a certain risk here of confusing our listeners a bit, because there is a distinction between expected returns and realized returns, and there are some intertemporal dynamics here at play as well. In other words, if your firm becomes riskier, your cost of capital goes up, that means higher returns to your current investors, and yet that tends to have negative consequences on firm profitability going forward. Your marginal net present value project becomes negative, and effectively you grow more slowly, right? It tends to have a negative effect on your growth rates and your profitability going forward. Nevertheless, it's an interesting, nuanced finding here.
Probably the popular paper in emissions right now, right? I would say in our literature.
Fair enough. I have another paper here that I did want to mention, a Journal of Corporate Finance by Dale Griffin and our dear friend Omran Gwedhemi, Kai Lee, and Guangli Lu. I love this paper because they don't just look at the United States and they don't just look at Western Europe, but they actually look at 43 countries over the period 2003 to 2015. They have almost 5,000 firms in their overall sample. And again, they find a pretty strong link to performance, a pretty strong link between environmental performance of firms and all sorts of corporate outcomes. This is not just stock price performance, but they find these firms have higher levels of cash flows, but actually lower cash flow volatility and a lower cost of capital.
Nice.
And yes, it gives
a lower cost of capital.
Yes, I suspect this comes from the loan side, right? I mean, they get cheaper loans because in the banking literature, I had a paper on banking trust. There are all these spillover effects, right?
This is consistent with the paper by Bolton and Kasperchuk, the 2021, because the firms with lower emissions provide lower returns, which would be consistent with the lower cost of capital. And you're right, like that's impressive that the paper you were mentioning by Omran
Omran, yes.
and Kylie and co-authors, they are looking across multiple countries because the paper by Bolton and Kasperchuk looks at the US specifically. So they look, over a long period of time, 2005 through 2017.
Yeah, and this is something interesting. I don't know how much time we want to spend dwelling on this, but when it comes to some of this relationship between corporate social responsibility and firm performance and firm value, the strongest finding is that usually not coming from the United States. Maybe we should actually spend just one moment mentioning brown firms versus brown industries, because there is a danger here of identifying specific industries or whole industries as being on the wrong side of this debate. And I think it's a fallacy that perhaps even we fall guilty of when chatting about this.
What we mean by brown industries or non-environmentally friendly industries are industries that are more likely to pollute, like industries that deal with oil, refining, and exploration and production firms. Patrick Bolton and Marcin Karspechuk mentions that specific to a few salient industries in which we see the biggest emissions and the biggest pollutants, certain firms in those brown industries get some additional screening by their institutional investors, meaning that institutional investors or the owners of these firms in the brown industries know which firms are the brownest and which firms are the greenest. Because within an industry, even if it's a oil polluting industry, if it's an exploration and production industry, there could be green firms that actually file a lot of green patents and try to make the exploration activities as clean as possible. And there's other firms that don't do the same. And it seems like the authors point out that institutional investors provide extra monitoring to these brown firms in brown industries, those that do not try to be good on E.
I guess what I'm taking away from this point is that ultimately we should always be looking at these ratings within an industry and not necessarily across industries, right? Because, of course, if you're a manufacturing firm, I mean, let's not go to the extremes of oil firms, right? But even if you're a manufacturing firm of any kind, of course, you're going to produce more emissions than if you're a tech firm, right? Mm-hmm. Maybe that's not even true today, right?
Because no, it's still
but,
true. It's still true, yes.
But the point is, some industries are going to be more or less socially responsible, right? By the nature, but
we're talking about environmental responsibility right now. But yeah, it's true. Some industries will be more environmentally conscious and others would be less environmentally conscious. And some firms within those industries will also differ in how they think about environmental responsibility. So this was in the Wall Street Journal. It's an article about Ziploc. So basically...
Ziploc, like the bags?
Ziploc, like the bags.
Okay,
yeah.
okay.
So,
you're surprising me here, Kate. I don't know where you're going with this.
So single-use plastics, right? So if you think about the environmental impact of single-use plastics, it's very damaging to the environment. Single-use plastic Ziploc are not commonly recycled. 40% of the world's millions of tons of plastics produced in packaging ends up being the single-use plastic. And over 85% of that plastics ends up in a land. Interestingly, Fisk Johnson, who is leading the company, he's a fifth-generation CEO in this family-run SC Johnson company, which makes Ziploc bags, Miss Mayer's Clean Day soaps, and Windex cleaners. He's actually a huge supporter of the clean environment. He's an interesting person overall. He has 5 degrees, and including like a PhD in physics. And he is very concerned about the environment. And kind of an oxymoron. You have this very brown industry producing single-use plastic, and you have a CEO who cares deeply about the environment. And so this is an example of a green CEO or CEO with green values and trying to have his firm perform in green matters in a brown industry.
So, but do they perform well?
I have not looked at the stock chart of SC Johnson to see how it compares like with the S&P 500. So I don't know if they perform well. But one thing that he says in his defense of like, why is he producing such a terrible product for the environment? He says, all right, you could say, well, single-use plastics is terrible business and we could just get out of it. But somebody else who's less well-intended is going to just take that up. It's a free market. My argument is that it's better off in our hands because we are trying hard to make changes. So what I can say is that he is using 5% of his pre-tax profits in his company to fund a team that directly reports to him that's focusing on addressing global health problems and reducing some of the issues associated with plastics and plastics recycling.
Okay, yeah, that's super interesting. I guess the big point here, we can have green firms in brown industries.
Aiming to be green, right? They still produce a lot of plastic. So I guess there's a spectrum. You are right. The industry is really important. But I just want to point out that within each industry, there's some firms that are green, even if an industry is brown.
Fair enough. I was more interested in the more explicit link to performance. I think you had a paper by Pastor and Stumble, if I'm not mistaken.
Pastor, so it's Lubos Pastor, Robert Stumble, and Lucian Taylor.
All right.
It's a paper published in 2022. They dissect the green returns. They show what they call the greenium. The greenium.
Oh, I love that.
The
So
greenium.
what's the greenium?
The greenium is the return of...
It's the green premium? Is that what the
green
greenium is?
premium, yes.
Oh, wow.
yes,
Okay.
yeah.
Okay.
Yeah, basically the return of green stocks over brown stocks. And
Okay.
they show that from 2012 till now, and they start in 2012 because that's when the data becomes available. So that's in the period when people have really been caring about climate. And this climate concern has been at a much higher levels than in prior historical periods. They create these portfolios of green firms and brown firms. And basically, they show that the portfolio of green firms outperforms that of brown firms by 174 percentage points. So over 2012 through the recent time period. They also bring an interesting example of German green bonds that have outperformed their higher yielding non-green twins as this greenium widens. So there's several examples there showing that green assets deliver higher returns in the recent years. So they're very specific about this recent year phenomenon because we've had a higher concern for climate.
All right, Kate, but I still think you were going to tell me something about green firms versus green industries.
And in this paper, their main idea is looking at green firms versus brown firms. And this 174% return difference sounds striking.
Yeah, that's huge, right?
Yes, that's right. That's right. Cumulative return difference. But industries really play a large role. So
Gotcha.
whether you're a green or a brown industry does explain a large proportion of this 174% difference.
So 174 is not industry adjusted. So once they adjust for the industry, is there still?
There's still a difference. Whatever the characteristics of that industry, let's say it's brown, you still do better if you are a greener firm in that industry. They have information on that as well. But the main point is that industries explain a larger 3 times more of that 174% difference.
Oh, that's interesting. The greenest firms within an industry still outperform the brownest firms within an industry, but across industry effects are much stronger than within industry
So you might want to participate in like green industries.
Makes sense. And I guess that matches what my intuition would have been about this, but those are some really interesting results.
Again, I have to point out they are very specific. That this is from 2012 through now, when our climate concerns have been the highest.
Got you.
Let's see if we can summarize. Are we ready to summarize E?
Oh, yes.
So what are the main takeaways here?
The main takeaway is that, to go back to our original question, do socially responsible firms, do environmentally conscious firms in this subchapter underperform? Again, the answer is very, very resounding. No, they do not underperform. Now, when it comes to evidence of outperformance, as always, it's a little bit more controversial. And the correlation is clearly positive. I mean, there's the study after study after study here showing that firms that rate high on the E dimension actually have high stock race performance. Right? But as always, correlation is not causation. Let's be clear, the channel that's usually identified here in the literature, it's a legal channel, right?
Seems like not only legal, it seems like the Bolton and Kasperchuk paper also points to the cost of financing channel. It's more expensive for these dirty firms to borrow money as well. So there's several channels.
Okay, fair enough.
Makes sense. Okay, that sounds good for E.
Awesome. Well, Kate, they say that professors are in love with the sound of their own voices, and perhaps you and I are not exceptions to that rule. This episode is getting a little bit longer than we were originally planning. So why don't we wrap it up here and then split it into a 2-part episode? So let's conclude this, and then we can invite our listeners to listen to part 2 for the discussion on the S of ESG, the social part.
Well, I guess what we need to say now is thank you, our listeners. If you've enjoyed this podcast, please like us, follow us on your favorite podcast platform, and we would love to hear some feedback.
Indeed, and stay tuned for future episodes of Questions in Finance. Cheers.
Ciao.